Most financial instability isn't caused by a lack of income. It's caused by a lack of signal clarity. Think about what that means for a second. When Simons and his team at Renaissance Technologies were analyzing markets, they weren't just drowning in data randomly. They were ruthlessly filtering. The question was never, what's happening? The question was always, what actually matters? And they discovered repeatedly that the signal, the real actionable information, was buried under an enormous amount of noise. Emotional reactions, short-term fluctuations, headlines, the financial equivalent of someone shouting in a crowded room. Now bring that to your personal finances. Every day you are surrounded by financial noise. A sale that ends today, a friend's vacation photos that make your current lifestyle feel inadequate, an article telling you that the market is about to crash, or that property is the only real wealth, or that you need to start a side business immediately. All of it is noise. And here's the brutal truth. Most people make their most consequential financial decisions in direct response to that noise. They spend impulsively because something feels urgent. They save inconsistently because motivation comes and goes. They invest based on what's trending rather than what's working. The result is a financial life that feels reactive, chaotic, and exhausting. The minimalist rule that Simons embodied here is this: define your signal and protect it from the noise. In practical terms, that means getting radically clear on three numbers. What comes in? What must go out? And what is left? Not a complicated spreadsheet with 47 categories. Three numbers. Because clarity, not complexity, is what creates stability. When you know your signal, your real financial position, stripped of illusion, you can make decisions from a place of logic rather than emotion. And that is where everything begins to shift. Now, here's where it gets interesting, because knowing your signal is only the beginning. The next layer of Simon's financial philosophy is something that most people find deeply uncomfortable: the separation of emotion from financial decision-making, not the suppression of emotion. The separation. There's a difference, and it matters enormously. Suppression means pretending you don't feel anything. Separation means acknowledging what you feel and then making your decision based on data anyway. Simons and his team famously built trading systems that remove human discretion from the equation entirely. Not because emotions are bad, but because emotions are systematically wrong in specific, predictable ways. Human beings, when it comes to money, tend to hold losing positions too long because admitting a loss feels like admitting a personal failure. They tend to sell winning positions too early because locking in a gain feels safer than watching it potentially disappear. They spend more when they feel wealthy and hoard when they feel scared, both at exactly the wrong times. These aren't character flaws, these are patterns. And Simons was a pattern man. So what does this look like in a personal financial life? It looks like automating the decisions that you are most likely to get emotionally wrong. Your savings rate should not be a decision you make each month based on how you're feeling about life. It should be automatic, structured, and frankly, invisible to your daily awareness. The moment money hits your account, a predetermined portion should move without your involvement, without your permission in the moment, without giving your emotional brain the opportunity to weigh in. Because the moment you give yourself the choice, the noise rushes in, you remember the thing you wanted, you tell yourself it's just this 1 month. And the compound effect of that habit, run in reverse, is devastating over time. This is the second minimalist rule. Automate your highest leverage financial behaviors. Savings, debt payments, investment contributions, all of it should run like a well-designed model, not a daily negotiation with yourself. When the system runs itself, your emotional state becomes irrelevant to your financial trajectory. That's not cold or robotic. That's extraordinarily liberating. You're essentially protecting your future self from your present self. which is, when you think about it, one of the most loving financial decisions you can make. The third principle, and perhaps the most misunderstood one, is the role of simplicity in building wealth. There is a persistent myth in personal finance that the wealthy must be doing something complicated, something with leverage and derivatives and tax structures so sophisticated that they require a team of accountants to explain. And while that may be true at a certain scale, it is catastrophically misleading advice for anyone who isn't already at that scale. Simons himself was famously direct about one thing: complexity is only valuable when it produces better results than simplicity. When it doesn't, complexity is just a way of hiding from the fundamentals. Here's what simplicity actually looks like in practice. Spending less than you earn every month, without exception, not because you're being deprived, but because the gap between what you earn and what you spend is the only raw material you have to build with. You cannot invest what you've already spent. You cannot compound what doesn't exist. Every financial strategy in the world, from the most basic savings account to the most sophisticated algorithmic portfolio, begins with this single input: a surplus. And yet, the overwhelming majority of financially unstable people are focused on increasing income as the solution, when the actual problem is that their surplus is zero or negative regardless of what they earn. A person earning $40,000 a year with a 5% surplus is in a structurally stronger financial position than a person earning $120,000 with a 0% surplus. Because one of those people has raw material to work with, the other has a lifestyle but no foundation. Simons would recognize this immediately as a structural problem, not an income problem. The fix is not to earn more first and then save. The fix is to create the surplus now at whatever income level you're at, and then grow it as your income grows. This is the third minimalist rule. Protect the surplus first, then optimize everything else. Your surplus is not what's left over after you've lived your life. Your surplus is a non-negotiable output of a deliberately designed life. Treat it that way, and your financial stability becomes almost mechanical in its reliability. You know that feeling when you finally get a raise and you think, now I'll start saving properly? And then 2 months later, your expenses have quietly expanded to fill the new income, and you're somehow still at zero. That phenomenon has a name: lifestyle inflation. And it is the single most efficient destroyer of potential wealth that exists. Not market crashes, not bad investments, lifestyle inflation. Because it operates invisibly at the exact moments when people feel most financially optimistic, and it converts what should have been compounding wealth into compounding comfort that leaves no trace. Simon's approach to this isn't asceticism. He wasn't arguing that you should live like a monk. The argument is far more precise than that. It's that your financial behavior should be designed in advance, not decided in the moment. When you get a raise, the question shouldn't be, how can I improve my life right now? The question should be, what percentage of this increase will I permanently redirect to my future? And what percentage will I allow into my present? If you allocate the raise before you feel it, lifestyle inflation becomes impossible. Your lifestyle can improve gradually and intentionally while your surplus grows simultaneously. But this only works if the decision is made with a clear head before the money arrives, before the emotional brain gets involved. This is actually one of the more elegant things about the quantitative mindset. It doesn't ask you to be superhuman. It asks you to be strategic exactly once, so that you don't have to be disciplined every single day. One good system beats 1,000 good intentions. And the people who consistently build wealth aren't necessarily more disciplined than the people who don't. They've just made the right choices, structural rather than voluntary. Now let's talk about the fourth principle, because this is where the philosophy shifts from defense to offense, and it's the one that most people rush to before they're ready. Investing. Specifically, the quant approach to investment thinking applied simply and powerfully to an ordinary financial life. Simon's entire career was built on one core insight. Past patterns, properly identified, contain predictive information about future behavior. He wasn't guessing, he was measuring. And while you and I don't have access to the algorithms that ran Renaissance's medallion fund, we have access to the same foundational truth that time in the market with consistent inputs produces statistically reliable compounding outcomes. This is not exciting. It is not the story of a brilliant stock pick or a perfectly timed crypto entry. It is, in fact, deeply boring when described out loud. And that's exactly why it works, because boring and consistent is the profile of something that compounds. Here's the mechanism, explained simply. If you invest a fixed amount every month into a diversified, low-cost index fund, you automatically buy more units when prices are low and fewer units when prices are high. This isn't a clever strategy. It's an arithmetic consequence of investing a consistent dollar amount. Over time, your average cost per unit ends up lower than the average price over that same period, without trying, without watching the market, without stress. The system does it for you because the system is simply consistent while the market fluctuates. And consistency, applied to a system that compounds, is one of the most powerful forces available to a private individual. The minimalist rule here is invest consistently, simply, and for a time horizon long enough to let compounding do the work you can't do manually. Don't try to time it. Don't try to pick the best performing fund of last year, because last year's best performer is statistically unlikely to be next year's best performer. Don't let the noise of market commentary convince you to pause, pivot, or panic. Simons would tell you, and the data would agree, that the most dangerous investor is not the one who picks bad stocks. It's the one who picks good funds and then stops contributing at exactly the wrong time because the headline scared him. Compounding is not magic. It's math. But it's math that requires time and continuity to function. Interrupt it repeatedly, and it becomes ordinary arithmetic. Let it run, and it becomes generational. The fifth principle, and the one that ties everything together, is what I'd call the feedback loop discipline. And this is perhaps where Simon's philosophy is most underappreciated in its application to everyday financial life. Renaissance technologies didn't build one model and then walk away. They were constantly measuring, adjusting, and improving. Not emotionally, not based on instinct or hope, but based on systematic feedback. What's working, what isn't? What does the data say, not what do I feel? For your personal finances, this translates into something deceptively simple: a monthly financial review. Not a panic session, not a guilt spiral, a clean data-driven review of your three core numbers: income, outgoings, and surplus. Are you on track? Has anything shifted? Is your savings rate growing as your income grows? Are your automated contributions running as designed? This isn't about obsessing over money. It's about maintaining signal clarity in a world that is constantly trying to fill your financial decision-making space with noise. A review that takes 30 minutes once a month, run consistently over decades, is worth more than any investment tip, any financial course, any hot take from a social media influencer who discovered their formula 6 months ago. Think about it this way: Simons didn't become extraordinary by making one brilliant move. He became extraordinary by running a process that was just slightly better than average, consistently over an enormous amount of time. The power was never in the individual trade. The power was in the system's discipline. And you have access to that exact same principle, not the algorithm, the discipline, the consistency, the willingness to trust a well-designed process over your own emotional reactions in any given month. Now, I want to address something that comes up whenever this philosophy is shared, because it's a real objection and it deserves a real answer. People say, this is all well and good, but I don't have enough money to start. Once I've sorted out my debt, once I've saved a bit more, once things settle down, then I'll build a system. And this objection, while completely understandable, is also the primary reason most people never begin. Because The myth of the starting point, the idea that there is a threshold of financial readiness that must be crossed before you can begin building, is itself a form of financial noise. You begin where you are with whatever surplus exists, even if that surplus is 5% of an income that barely covers your bills. You automate it, you protect it, you review it, you let it compound, because the person who begins with 50 units a month at 25 is structurally ahead of the person who begins with 500 units a month at 35 due to the mathematics of compounding time. The variable that matters most is not the amount, it is the start. And the start is now. Not after the next raise, not after the debt is gone, not after things calm down. Things will not calm down. Life doesn't offer a quiet moment to begin. You build while the storm is happening, and you let the system protect you from the storm's worst effects. This is arguably the most Simons-esque insight of all, that the best model is not the one that waits for perfect conditions. The best model is the one that runs in all conditions and is robust enough to produce reliable outputs even when the environment is unpredictable. Your financial system should be exactly that. Not contingent on a good month, not dependent on a perfect year. Designed to run quietly, consistently, and effectively, regardless of what life throws at it. So let's bring this all together, because individually these principles are useful, but collectively they form something that's genuinely powerful. Signal clarity over noise. Emotion automation over emotional decision-making. Surplus protection over lifestyle expansion. Consistent, simple investing over complex speculation. Feedback discipline over set-and-forget complacency. 5 rules, each one individually a step forward. Together, a system that compounds not just your money, but your financial confidence, your decision-making quality, and ultimately your sense of stability in a world that is structurally designed to keep you spending, reacting, and feeling perpetually behind. The people who follow this path don't become wealthy overnight. They become stable first. And then, gradually and almost quietly, they become wealthy. Not through a single brilliant moment, but through the relentless, boring, beautiful power of a system that never takes a day off. If this way of thinking about money connects with something in you, if you're tired of the noise and ready for a signal, then do something right now that costs you nothing but pays you forward enormously. Subscribe to this channel, because this is the kind of conversation we have here consistently every single week. Hit the like button, not as a gesture of appreciation, but as a signal to yourself that you're the kind of person who takes this seriously. And drop a comment below telling me one thing. Which of these 5 principles are you going to implement this week? Not this year, this week. Because a system that starts next year is not a system, it's a fantasy. A system that starts this week, even imperfectly, is real. The quant mind doesn't wait for certainty. It acts on probability. And the probability that any one of these principles, consistently applied, will improve your financial position over time is not a matter of opinion. It is a matter of record. The data exists. The question is whether you'll let it run.